All right, today we're jumping into a real financial detective story. We're talking about a piece of research that totally blew the doors off how we think about risk and return in the stock market. It's called the Fama-French three-factor model. You know, it all kicks off with that one big question that every single investor asks themselves. When a fund manager crushes the market, is it pure skill, just dumb luck, or is there something else going on entirely? For decades, this was a huge mystery.
So for the longest time, the official story was this model called the Capital Asset Pricing Model. You've probably heard of it as CAPM. And it was really elegant and simple. The whole idea was that an investment's return boiled down to just one thing, how sensitive it was to the overall market. That's its beta. That was it. That was supposed to explain everything.
But like any good detective story, there was a problem. A big one. When people actually looked at the data, the official story just didn't add up. They kept finding these weird, stubborn patterns. Academics call them anomalies. Two in particular were just impossible to ignore. Small companies were consistently beating the big guys, and these cheap, kind of boring value stocks were absolutely running circles around the fancy, expensive growth stocks. And CAP, it had absolutely no explanation for this. None.
And there it is. That's the central mystery. The reigning theory of finance was failing its big real-world test, and that set the stage for a complete revolution.
So enter our detectives, Eugene Fama and Kenneth French. Back in 1992, these two decided they were going to crack this case once and for all. They dove into decades and decades of market data, basically hunting for clues, looking for the hidden forces that could finally explain what was really driving stock returns.
And what they uncovered, wow, it wasn't just a tiny tweak to the old model. Nope, it was a whole new way of looking at the world, a completely new framework. So let's meet these three factors.
Okay, so think of Fama and French's solution like a new recipe for explaining returns. Instead of just one ingredient, it had three core ingredients, or as they called them, risk factors. And this new recipe did a way better job of explaining what was actually happening than the old one-factor model ever did.
All right, first up, they didn't throw the baby out with the bathwater. They kept the original ingredient from CAPM, market risk. This is the classic idea, right? You get paid extra for taking on the general risk of just being in the stock market instead of stuffing your money under a mattress. Pretty straightforward, no surprises here.
But now is where it gets really interesting. The second factor is size. They called it SMB, which stands for small minus big. And this directly tackles that first mystery we talked about. It captures the hard data showing that over the long run, small cap stocks have tended to outperform large cap stocks. That extra return you get, that's what we call the size premium.
And factor number 3 is value. They call this one HML, for high minus low. This factor takes on that second big anomaly. It measures the tendency of value stocks, companies with a high book-to-market ratio, basically stocks that look cheap, to outperform growth stocks. It's the perfect explanation for why those overlooked, boring companies have so often turned out to be fantastic investments.
Now, the way they actually built these last two factors is pretty genius. They're what's called zero-cost portfolios. So for the size factor, SMB, the idea is you'd buy a whole bunch of small stocks, and at the same time, you'd sell short a whole bunch of big stocks. By doing that, you basically cancel out the market's overall movement, and what you're left with is the pure, isolated return premium you get just from the size effect. Super clever.
So, there you have it. The model worked. It explained returns with startling accuracy, but that just opened up a brand new can of worms. An even deeper question, why does it work? And that question kicked off one of the great debates in all of modern finance.
Basically, two competing theories emerged. On one side, you've got the risk story. This is the camp Fama and French are in. They argue that small stocks and value stocks aren't outperforming for no reason. They're fundamentally riskier. Maybe they're more likely to go belly up in a recession. So that extra return, it's not a free lunch. It's fair compensation for taking on that extra danger. Then, on the other side, you have the mispricing story. This theory says it's all about human behavior. Investors are irrational. They fall in love with exciting growth stocks and bid them up too high, while they unfairly ignore the boring value stocks. The premiums, in this view, are just the market slowly, eventually correcting its own mistakes.
And Fama and French themselves, they are firmly in the risk camp. And their argument is pretty powerful when you think about it. They say, look, if this was just a simple behavioral mistake, wouldn't smart money have arbitraged it away by now? The fact that these premiums have stuck around for decades, and not just in the US but all over the world, that strongly suggests it's compensation for some kind of real fundamental risk.
Okay, so beyond all the academic debate, this model had a huge impact on the real world of investing. It wasn't just a theory. So let's look at how people actually put it to work.
Probably its biggest and most famous use is something called performance attribution. See, before this model, if a fund manager got a great return, you just say, wow, they're good. But now we can actually break it down, kind of like a financial autopsy. We can see exactly how much of their return came just from being in the market, how much came from their bet on small stocks, and how much came from their bet on value stocks. And then, and this is the crucial part, we can see what's left over. That tiny little remainder, that's what we call alpha. That is the true measure of a manager's skill.
And the evidence just kept piling up. As researchers started testing this model all over the world, they found the same patterns. These size and value effects weren't just some weird American thing. Nope. They showed up in Europe, in Asia, in emerging markets, pretty much everywhere. That global consistency was a massive piece of evidence suggesting that these factors are something truly fundamental about how markets tick.
But the story isn't over. Just when it seemed like this model was the new law of the land, a new plot twist emerged. Another mystery for our detectives, the case of the vanishing premium.
What am I talking about? Well, the size premium, specifically, has gotten a lot weaker in recent years. If you look at the data, the extra return for small stocks was pretty solid for a long time. But in the decades after Fama-French published their paper, well, in the US at least, it's been pretty lackluster. Sometimes it's barely even there. And this has kicked off a whole new debate. Now that the secret is out, has the premium been competed away?
And that really brings us to a key point. The Fama-French three-factor model wasn't the end of the story, not by a long shot. It was actually the beginning of a whole new chapter in finance, a new way of thinking that's still evolving today.
You see, the three-factor model really opened the floodgates. It kicked off a kind of gold rush for new factors. In 1997, researchers added a fourth one, momentum. Then, in 2015, Fama-French themselves came back and updated their own model to a five-factor version, adding profitability and investment to the mix. It's like building a better and better microscope to get a clearer picture of what really makes the market tick.
So in the end, the Fama-French model was an absolute landmark. It ripped back a curtain on the market and showed us all that risk was way more complicated than we ever imagined. It gave us this incredibly powerful new lens to understand performance and build smarter portfolios. And it proved that this financial detective story, it's never really over. Which leaves us all with one final, fascinating question. What other factors are still out there, hiding in the data, just waiting to be discovered?